Let me introduce first of all the panel to the group. On my right is Mr. Sanjiv Sahay, is former Secretary Government of India and the Ministry of Power, and he is one of the pioneers for creating many changes in the power market, what we see in India today. On further to his right is Mr. Arun Goyal. He was Secretary Government of India, and subsequent to that he was member CERC, and during that period the PMR 2010 was enacted, which is the backbone for the market today and the products which are being available in the Indian market today. On the further right we have Mr. S Barpanda. He was Director of Market Operation of Grid India, which is the central nodal agency for the grid operation as well as the market operation in the country. And if I am not exaggerating, he has seen the market when it was not existing and when it was having a substantial presence and it was a dynamic market. He was working there as Director of Market and Operation. So we are very lucky to have all three of them here to discuss the subjects which are very relevant, very important for the emerging power market in the country. So with your permission, sir, should we start? So sir, before I start asking questions, let me give you some perspective where we stand today in the Indian market and what are the little bit of challenges which we have to address to. As far as Indian market is concerned, we have around 470 gigawatt of installed capacity. Almost 50% of it comes from the thermal and 50% of it comes from the renewable, barring almost 1.5% of nuclear, which is in the portfolio. The market, what we call, or the power which is traded through exchanges, are to the extent of around 11 to 12% today. And rest of the power, almost 85% of the power, is sold through long-term PPAs. So all the conventional, mostly, and most of the renewables have a long-term PPA through which power is being scheduled. Power is scheduled through 96 time block for the next day, which we all know. But we are contemplating for our granular details to have power schedule in the time block of 5 minutes. That means 286 time blocks during a day. So that is what we are planning to do. What we are planning to do is 500 gigawatt of renewable in another 7 years. What we are planning to do further is we will spend almost 300 plus billion US dollars in this sector in India. We have already spent more than 200 billion US dollar or almost 11 lakh crores for the grid what we have today. It is one of the best grid in the world. But this is all we have done. But for another 7 years, the task is really humongous. And to enable this market to do all these things, I would ask the opinion, their understanding and the way forward, how the country can achieve all this to enable a vibrant power market. So sir, with this background, sir, when you were Power Secretary, the most important thing which I feel was the changes which you brought in the power market. And one specific area which I feel was very important was financial and derivative market and the hurdles which it was facing at that point of time, and you could clear those hurdles. Where do you see that financial and derivative market right now, sir?
Good morning, everyone. First question is, why do we need a financial market or a derivatives? Why do we need it in the first instance? Because you do have a PPA in 85% cases, etc. It's already fixed price, very, very safe for investors. But are PPAs very good for say, consumers? That's a question to be asked because it does stymie innovation. Anyway, to answer his question, I think as power markets deepen and as you have more and more renewables coming in, there will be variability. Whenever there is variability, there is heightened risk. Right? The prices are not stable. Why do people take insurance? People take insurance because you don't know how the events will unfold, right? If everything was certain and there was no risk, there was no need for insurance. So the financial markets and derivatives are insurance. These are financial instruments. Let's be first clear, these are just financial instruments and this is insurance against variability. So I can take an options contract because if I feel that the power prices may go up, I can take an options contract that even if it goes up, I will be supplied as a DISCOM or a consumer price at this point. To that I pay a premium right now. And if the prices cross the strike price, which is the price at which I have settled, plus the premium, I'm going to make money. Likewise, a seller may think the prices will not go up, or an option writer may think the prices won't go up and will pocket the money in option. So this is basically a game of insurance. And you have different kinds of derivatives, right? You can have a future market, you can have options, you can have swaps on your cash flow. Swaps are not that common in electricity markets right now, but options and futures, call and sell options are common. They're common. So my first point is that if the power markets deepen and as renewables come in and as you tighten DSM and the payments that you may need to bring about because of variability, people can invest in batteries, say in solar to even out supply. But it may be well worth the while for people who speculate in the market, for traders, where they have entered into physical delivery contracts to hedge their risks, to go to the financial market where settlement is done financially. Let's be very clear, there's a big distinction, I'm sure they know, there's a big distinction between the physical delivery market and a financial market. Those are just financial instruments where settlement is done on financial basis. You just net out the costs at the strike price. The strike price and the real price. That's all you do. So I do see, and in my time, NSE had actually applied.
Supplement to whatever you are saying, to make them understand the concept. The liquidity in the market is the biggest constraint in the physical delivery market. Because today, if you are trading power, it is only traded once. That means if you enter into a contract and you are finally delivering, it's only once that the transaction will be done. In the financial market, it can go up, and in European market, we know that it can be 7 to 10 times also. So, do you see that in Indian context, the multiplication of these transactions can lead to better liquidity in the market?
Better liquidity
because the market depth is missing in the physical delivery market. So
it will over time, yes, of course. The more people see that they can actually make money on the financial markets, there's a higher incentive to have more physical delivery contracts, right? Because they are actually at the end of the day contingent on the spot prices either in DAM or in RTM.
yes.
Day-ahead market, DAM is day-ahead market, and RTM is real-time market. So it will, because otherwise, how will the depth of financial markets? How much on few spot prices? Because that doesn't give enough data for people to be able to figure out where the market is going to go. So it will incentivize, yes. But there are many other reasons which will going to cause physical delivery markets to probably become deeper, and that is one is that discount won't long.
Sir, I'll come back to you, sir, on this. This is something which we will be discussing a lot. But let me go to Mr. Goyal. Sir, you were the architect of PMR 2021, and which was an amendment basically of PMR 2010. So when we were amending it in 2021, what was the intent, and do you see the market could achieve what you wanted to intend with this?
So, the earlier act that we had in India was Power Markets Act 2010. So that was amended in 2021. So at that time, we were seeing what is happening in the power market. So renewables were playing more important role. So variability was one more thing that was happening. So in that context, the power markets were to play a more important role. Because you see, what we found was that everyone wants to actually trade closer to the real time. So that is why around 2021 towards the end, we also introduced real-time market. The purpose of real-time market is that you bid around 1 hour before the actual delivery time, and then the market is cleared, and then you get the power after 1 hour. So just to give an example, now what is happening is that in India, we have more than 100 gigawatt out of 460 gigawatts, or more than 100 gigawatt of solar, more than 50 gigawatt of wind. So these are all very, very unpredictable. And then we have a concentration. Solar power is there in few pockets. So, there is a huge solar park, all of a sudden there is a cloud cover. So you don't get that kind of a power, but your demand doesn't reduce. So to cater to that, you have to buy closer to the real time. So that is why the concept of real-time market is there. So that is just, I am giving you by the background. So some of the major changes that we try to bring about was that in our earlier power market regulations, it was for the 11 days only, the term ahead market was there. So that was extended up to 11 months. So but now after we made that amendment, then we got petitions from different exchanges. But at present we have only allowed the term ahead market for 3 months. So the CERC is being little cautious in this, they do not want to really take a step together and then see how the market is behaving. So at present you can buy power 3 months ahead, and these contracts can be on daily basis, weekly basis or monthly basis. So that is how this one was there. So another thing that we did was to cap the amount of the commission that the power exchange would get. So earlier there was no limit that was put. So now that is being put as 2 paisa on either side, 2 paisa per unit. So that can be the maximum commission. Of course the exchanges are free to charge lesser than that, but that is the maximum limit. Then another very important thing was that we were seeing in the Indian context that RTM and DAM, they are manipulated, majority share is with one exchange. So that is around 99% of the market share of DAM and the real-time market is with one exchange. Now why this is happening is the way that system is designed, So here we get the aggregate demand, aggregate supply. So there is a window when the bids are made, then all the bids are aggregated together, then aggregate demand curve and supply curve is made, and then the market clearing price is there. So now other exchanges are also trying their best to make inroads into this DAM and this, but some of them not been successful, because in India most of the purchasers are the government companies. Now when they try to buy from the other, they find that the price that is determined may be more than one of the exchanges which at present is having most of the transactions. So that is why we made that enabling provision of market coupling in the Act. And market coupling, what it says is that even there are more than one exchange, 3 exchanges, then whatever the bids are received by the 3 exchanges, they will be accumulated together by the market coupler, and then the clearing price will be determined, and it will be the same clearing price which would be applicable for all the 3 exchanges. Of course, there are, that is why by the time when we were framing the regulations, we were not able to come to a consensus whether it should be introduced or not. So that is why an enabling provision was made. But then thereafter, now what we have done is that the CERC, they are running a pilot project where the Grid India is involved, and on a shadow pilot basis, so whatever the transaction that they take place in the 3 exchanges, they are being put together and a shadow pilot is being run for the market coupling. Of course, it is still at this, and then a decision has yet to be taken whether market coupling has to be there or not. Yeah, so this is one, and then considering that the exchanges are going to play more and more important role as we go forward, so more stringent market monitoring mechanisms were put into place, and also the exchanges were asked to share their data through the APIs on the real-time basis. So these all changes were there, some of the changes, so I can supplement it if you want anything more on this.
Certainly, sir. We will take it forward because there are other products which you just mentioned, and we will deliberate more on that, like OTC market and other products. But we'll come to that. Before that, Mr. Barpanda, you were there in the market when the first Act of 2003 was enacted, which enabled the market to take shape. And at that point of time, the entire thing was running on a long-term bilateral contracts only. From there, we are almost 22 years since then, and we are seeing at least a dynamic market where several products are being introduced, and some of the products are successful, and in the market we are seeing that some of the products are not so successful, and market is rejecting it themselves. So tell how the things have shaped up by just a bilateral contract initially with a trader, then in 2008 the exchanges came into existence, and now multiple exchanges with multiple products in the market, including allowing cross-border trade to take place on the India exchanges. So tell your journey, and then we will ask you specific things.
Thank you. Respected panelists, distinguished delegates from India and neighboring countries. So, as explained by Mr. Sahay initially, I have seen the market during my career. That is Eastern Electricity Board at that time in 1988, and at that time there was no market. And over a period of time, I have seen how markets are evolved in India. And as mentioned by Mr. Sahay, Electricity Act was enacted in 2003. But foundation of market was laid even before that, because many of you must have heard of Mr. Bhanusan, the visionary. So he had thought of 15-minute block-wise metering and accounting and settlement in each 15-minute time block. Okay, so all the meters were in place even before enactment of the act. Then EBT was implemented. That was a major milestone. EBT was implemented in 2002. So before that, what is happening? All the settlement was between the parties, and it is based on energy drawal, total drawal. So there is no scope of any charge for deviation. So with EBT, divided into three parts: capacity charge, energy charge is based on schedule. So any contract is there, based on schedule, one party will pay to the other party, buyer will pay to the seller, and deviation has to be settled separately through a pool. So that is a major change in the market. So once that was there, that was in place, then it was very easy to introduce more products in market, because what happened, now any entity, they could go for multiple transactions. Some seller is there, they could go for five transactions with 5 different buyers. All the transactions will be taken together, their schedule will become the data, and whatever is the deviation, that will be settled separately. Similarly for buyer also, they could go for multiple sellers, they could buy from multiple sellers. So this started in 2002-03. Then with Electricity Act, we had this open access. So CERC came out with first regulation on open access in 2004, and based on that, at that time there is single regulation both for long term as well as short term. So open access started in 2004. Many traders came out. PTC, Dr. Mishra was there earlier. So PTC had come up even before that. So, and even I would say PTC had started one trade between Eastern region and Northern region, maybe late 90s. Yes. So many traders came, and gradually then volume also picked up. Then there is perpetual congestion because transmission system was not adequate. So at that time, this CERC came up with a discussion paper on staff paper on Power Secy. It came up in 2006. Public hearing was held, during that hearing, a lot of debate was there. Whether we should have one power exchange, we should have multiple power exchanges, whether that power exchange should be owned by a government company or it should be a private enterprise. All this debate went on. And finally, CERC decided that okay, let innovation be given scope. So they said that okay, let there be multiple exchanges, and this need not be a government enterprise. Private enterprise can also be there. So two exchanges came up. One IEX, other is Power Exchange India Limited. Subsequently, HPX also came up. So now there are three exchanges in India, and of course, as mentioned, major share is with one of the exchanges. Because what happens normally, even in marketplace also, when you go to market, you see a lot of rush in one shop. So you think that okay, we should go there and we should purchase something because rates should be reasonable. So market price discovery is better when you have more volume. So that is probably the reason why everybody goes to that exchange. But of course, as you already mentioned, CERC has come out with an enabling provision in the regulation, and that along with that enabling provision, now CERC has issued one order also. In that order, they have directed Grid India to carry out a pilot project on market coupling. So once market coupling is there, all the trades in power exchanges, they will be taken together and one price will be discovered. So in that case, whether one goes to one exchange or other exchange will be invented. So that pilot project is going on. Hopefully actual market coupling will take place in future. So that is one part. And tell about another thing, is transmission pricing. CERC came up with one regulation on transmission, sharing of transmission charges and losses in 2010. And that was implemented in 2011. Before that, what happened? Actually, all the transmission system, it was shared regionally. Then some transmission systems were to be shared by other regions also. For example, in western region, some ultra mega power projects were set up, and those projects had allocation to different entities in northern region. So northern region had also to share transmission charges of those. So things become very complicated, and even chairperson CA had to convince the states to agree to pay for it, because people said that okay, why should I pay for it? So that continued. So at that time, that regulation of CERC came at the right moment, and after that, what happened? A national pool was created, and the sharing mechanism was there. So because of that national pool, transmission system development was very fast, and the perpetual congestion we faced, that was eliminated. Now practically there is no congestion. From any part of the country, you can take off to any part of the country, there is no issue. So robust transmission was developed because partly, maybe there may be other factors also, but partly it was due to the regulations issued by CERC for sharing of transmission charges and losses. So these are some of the major developments, and right now multiple products have already been introduced, GDAM, GTAM, even there is petition by IEX for GRTM, green RTM. So things will evolve gradually, and even for this derivatives product will also come. So things are going, and I am hopeful that in future it will be better. So we shall discuss more as we go on.
All right.